Imagine two neighbours, Arthur and Bill. They live in identical houses, they worked for the same company, and they retired at the same time. This year, they both need £22,000 to live comfortably. They have the same life, the same money, the same country. Arthur takes what most people would do. He receives his state pension. Then he takes the rest from his pension pot. Well, it feels logical. It's my money. I'll just take what I need, he thinks. But in January, a brown envelope arrives from HMRC. Arthur owes over £1,000 in tax. Now look at Bill. Bill receives the same £22,000. Same lifestyle, same spending, but Bill pays nothing in tax. Bill is not doing anything unusual. He simply understands something most people are never shown: how the system actually works. Because the UK tax system doesn't just care about how much you receive, it cares about where it comes from, when you take it, and how it is classified. Once you see that clearly, everything starts to make sense, and you will have the knowledge to reduce your tax bill, sometimes to zero. Hello, it's Angie, and this is UK Money Wisdom. This video will show and explain 6 ways that a zero tax bill can be achieved. First of all, I want to begin with fiscal drag. You may have all heard of that phrase. Fiscal drag is pushing more pensioners into paying tax for the first time and increasing the tax bill for everyone. Just look at this table, which shows you the vanishing gap. Let's walk through this slowly. We start with year 2010. The state pension was around £5,000. The personal allowance was around £6,500. That left about £1,475 of space. And that's important because it meant you could have a small private pension, you see. You could even do a bit of part-time work, and you could earn some interest and still not pay any tax. But now look at today. The state pension is £12,547. The allowance is £12,570. That leaves just £22. There's no room for anything much else, is there? Look at this simple example. If you receive £12,547 pension plus £100 from a small pension, yes, just £100, you are now over the allowance, over the threshold, and you will begin to pay tax. So let's look at the ways to move towards a zero tax bill. Way number 1, that's the income versus capital way. And the theory behind it is staying under the personal allowance here. If your taxable income stays below £12,570, you pay nothing in tax. This is the obvious method and impossible for many to achieve now. The reality is that most people are already close to the limit because the state pension almost fills it entirely. So the real question becomes, how do you access more money without increasing taxable income? In way 2, let's look at an ISA. I call it ghost money. And here's the table that shows you how this works. It also shows you how HMRC sees it. You see, pension equals income, whereas an ISA is your own money, your invisible ghost capital. A pension uses your allowance while an ISA is ignored, which means that on withdrawal, a pension is taxed, but an ISA is not taxed. We all know that the ISA is usually taken from income where tax has already been paid, hasn't it? But many people forget that any withdrawal is then tax-free. Even interest from many savings made from pre-taxed income can still be taxed by HMRC. So it is very important not to forget about this useful way to avoid tax, and many can reduce their tax bill to zero. Here's a withdrawal example showing the pension versus the ISA method. Say you need £5,000 extra this year. If taken from a pension, HMRC sees £5,000. You're already at the allowance, so you'll be charged tax at 20%. You will receive only £4,000. That's right. But if taken from an ISA, HMRC sees £0. There's no tax, and you will receive the full £5,000. It's the same withdrawal, but £1,000 difference. And that is exactly the way Bill beats Arthur. Let's move on to ways 3 and 4, which is all about timing and savings. Way 3 is the bucket principle, where you think of each tax year as a bucket. Every pound you take goes into that bucket. If the bucket fills up, tax starts. Here's a timing example. Suppose you need £20,000 for a car. In option 1, you take £20,000 in March and tax is triggered. Whereas in option 2, you take £10,000 in one tax year, that's in March, and £10,000 in the next tax year after the 6th of April. Different tax years, you see, which can mean possibly no tax. The key idea is that timing is not a detail, but an important strategy. Okay, now let's look at way 4 and the savings allowance. Look at the savings secret, and we'll take this step by step. In the first example, where there is only state pension of £12,547 as income, your interest still fits within allowances and there'll be no tax, of course. In the second example, we see that income is higher, but still within the basic rate. So the PSA, that's the Personal Savings Allowance, still protects you. In the third example, however, where income is much higher at £55,000, allowance reduces and tax begins. The key insight here is that savings are treated differently. It's like a second system inside the system. Way 5 covers the lump sum rules. Look at this table and you see that the lump sum limit controls how much tax-free you can take. Most people, you see, focus on 25% tax-free, but behind that there are these lifetime limits shown. Lump sum allowance, £268,200. £1,275. And there's the death benefit allowance of £1,073,100. Way 6 shows you how uncrystallised fund pension lump sum works. That's UFPLS for short. It's something most people are never told. If you take money from your pension normally, every pound counts as income. So, if you take £12,570, that's your full allowance gone. But the UFPLS method works differently. Every £1,000 you take is split. There's £250 tax-free and only £750 counts as income. So instead of hitting the limit quickly, you stretch it. And that means you can take around £16,700, while HMRC still only sees £12,570. It's the same tax position, but thousands more in your pocket. That's not a loophole, that's simply understanding how the system works. And if you want to know more about this, do write to me in the comments below. Let me show you how it works briefly in this example. And I call this the stretched allowance strategy, and it's for 2026-27, of course. This is the magic trick of the UK pension system, because every UFPLS payment is legally mandated to be 25% tax-free and 75% taxable. The taxable portion is the only part that fills up your personal allowance bucket. Here's the maths. Total cash, £16,760. The 25% tax-free element is £4,190, which HMRC will ignore. The 75% is the taxable element. That is £12,570, and it matches your personal allowance exactly. And the result is you have an extra £4,190 to spend. But on paper, you haven't earned a penny over the tax-free limit. It's not what you take, you see. It's what HMRC sees. Let's look at inheritance tax and this table. Historically, pensions sat outside inheritance tax. Going forward, that protection may reduce. And the key warning here is old assumptions may no longer apply. Now, everything we've just covered about pensions on death shows something very important. The system doesn't just care about how much money there is, it cares about how that money is structured. I keep talking about structure, but that matters significantly where HMRC are concerned. Yes, HMRC cares about how that money is structured, it cares about how it's classified, and it cares about when it's taken. And that doesn't just apply at the end of life, it applies every single year while you're living. Because the exact same rules that determined what your family keeps are the rules that determine how much tax you pay today. So let's bring this back to something simple and real. Look at these two people. They've got the same life, same income, but completely different outcomes. Look at this table carefully for Carol and Joanna. They both receive the same £17,500. They live the same life. They spend the same money. We're assuming that, of course, for this example. But Joanna crosses the line and pays nearly £1,000 in tax, whereas Carol pays nothing in tax. Why? Because Joanna's extra £5,000 comes from a pension, so HMRC sees it as income. Now Carol's £5,000 comes from an ISA, so HMRC doesn't see it at all. And that's enough to trigger a tax bill. The difference is not the money, it's the structure. And once you understand that, you stop reacting to the system and start working with it. So here is a final checklist for you. And step by step, it shows you what to do and why. Please check your pension and know what your base is. Do check your national insurance and avoid any gaps. And you must identify the type of income and plan. Wherever possible, use an ISA in order to avoid tax. Number 5, spread your withdrawals because it will control timing. That's one of the things that will affect your tax. Number 6, use the 25% method that I've shown you to reduce tax. And number 7, check your interest. Use allowances wisely. Finally, step 8, do your annual review. That will help you to stay in control. You do not need to do everything because even small changes create better outcomes. If this helped you and you would like to see more of my videos, please would you subscribe and like this video and do share with a loved one who might be able to use this information also. And please write me in the comments if you need any further explanations or you've got any help to offer us. You can catch up with my other videos with this link, which I will put in the description below. I always provide information for you to use in order for you to be able to make up your own mind about the decisions needed on the way forward. I'm Angie, and this is UK Money Wisdom. I'll be back with you again very shortly. In the meantime, take care. Bye for now.